This is level 3 of the CFA program, the topic on behavioral finance and the reading on behavioral finance and investment processes. Let me just quickly remind you what we did back in the first reading here at level 3. We defined behavioral finance and behavioral biases. Recall that we divided these biases into kind of two mistakes. We called mistakes of the brain, we called those cognitive errors. Mistakes of the heart, we called those emotional biases. And so the focus of the LOSs were mostly on identifying those particular biases. It was almost like a psychology class. We did sprinkle some finance in that first reading, but in this reading, we're going to go ahead and layer this with lots and lots of finance. We're going to look at some models that are going to allow us to identify specific biases and attach a label to individual investors who exhibit those emotional biases and cognitive errors. And we're also going to ask, the big question is, all right, so we have a client who is exhibiting these behavioral biases. What do we do about it? And so if you look at these LOSs, notice there's lots of discuss and explain and describe action words. Look at that second one. Advisor-client interactions, then portfolio construction. And then at the end of the LOSs, we'll go ahead and extend this to financial analysts. We'll extend it to groups of people, maybe like a board of directors or maybe like a group of analysts. And then we'll talk about market characteristics in that last slide. Let's go ahead and focus on that first LOS for just a second. It's probably going to take us about 10 or 12 slides to get through this. Explain the uses. Let's focus on that here for just a second, on classifying investors. What did I say in that introduction? Attaching a label. So the official LOS is classifying. So what are the benefits here? Of course, the more of a positive relationship that we have with our clients, the more we know about our clients, the more our clients know about us, and our decision-making process will improve that relationship. And so I try to teach my students this all the time, that if, as a wealth advisor, you are sensitive to your clients' behavioral issues, they're probably going to be more comfortable in explaining those to you and then the consequences, et cetera, et cetera. So that's an important one, improved relationships. The second one is one that I really like. Let's go back to the 1952 Harry Markowitz Efficient Frontier. And remember, we have these kind of mutually exclusive goals. What are we trying to do? We're trying to get the most expected return out of the least amount of risk. And so our job as wealth advisors is to try to push that nonlinear locus of points up into the northwest corner. And so this is what we're trying to do, is we're trying to say, okay, we're faced with these behavioral issues, but we don't want to let them get in the way of providing an optimal portfolio. So if you combine those first two, clearly you're going to get more satisfied clients and you're going to be able to focus on that long-term strategic plan. All right, let's go ahead and start on a couple of these models. There's this Marilyn Barnwell two-way behavioral model, and I want you to think of this just as it's two-way. So I want you to think about this in two types. You have passive investors and active investors. And so you might be tempted just to say something like this. Oh, the passive investors are those people who have inherited their wealth. They didn't have to risk anything. They didn't have to do any hard work. But the reading is very careful to add a group of investors out there who have, and look at that first orange arrow point, have slowly accumulated their wealth with small, consistent gains. And in fact, the reading identifies a couple of careers that are indicative of a passive investor. They talk about corporate executives, which probably is a good link between what we're doing in these readings and then what we do in other readings on corporate finance. But I was fascinated. They also include journalists in there as a category. And so make sure that when you identify passive investors, they could have inherited their wealth, but they could have slowly risen in the ranks in the corporate world. They also included CPAs and non-surgical doctors. I think that purple arrow point is probably an important one. They are more risk averse. So here, you ready for this? Let's go back to this portfolios closer to the efficient frontier. So these portfolios will probably be closer to that minimum variance portfolio for the passive investor. What these passive investors like is they like a greater need for security over control. They feel like, okay, let's go ahead and put this in a little ball, and let me make sure that I know what's going on inside of that little ball. Compare that to active investors, and look at that first orange arrow point. Risk their own capital. Think of an entrepreneur, right? Less risk averse. They're willing to give up security over control of their wealth creation, and they are probably overconfident. Moving on to another model, this BB&K 5-way model. What this does is it breaks it sounds like 5 ways, and it is 5 ways, but it breaks it into 2 dimensions: level of confidence and method of action. So I want you to focus on that blue box that we have in the middle. Here's the first of the 5 ways, the straight and arrow investor. And I'm going to go out on a limb here. This is not part of the reading, but going back to Harry Markowitz in 1952, William Sharpe in 1964, and all those other founding fathers of finance, recall that they based their models on the assumption that investors are rational. And so I kind of think of that straight and arrow investor as kind of the rational investor. It's not specifically, and it's not mathematically the same, but I think that's an okay kind of an analogy. So sensible and secure, willing to take on more risk for higher expected return. And that, here, let me do this one more time. That links us back to the Harry Markowitz efficient frontier. All right, so think about that individual, just kind of in the middle. Not showing off, not falling behind. There's a George Costanza quote from Seinfeld. And so notice there are arrows going outward horizontally and arrows going upward and downward vertically. So this is where we get the other 4 individuals. So think of these others as break-offs or breakaways from the straight and arrow. So let's go upward first. So these two types of investors, these 2 classes of investors are very confident. So how do we distinguish between different levels of confidence? So look back up in the little purple box we have. How do we distinguish between levels of confidence? All right, so we're going to do this and say, all right, some are careful. So this is the individualist. This is a careful individual. They're confident, they're meticulous, they're careful. They say something like to the wealth manager, okay, that sounds like a good investment idea. Tell me how you arrived at that conclusion. Likes making their own decisions after careful analysis. Okay, easy to advise. On the other hand, if they are impetuous, let's call this individual the adventurer. Boy, they have a completely different attitude. They're confident, but they have a completely different attitude. Notice they're super confident. They're willing to take risks. They really don't like taking advice. They're probably hard to work with. And one of their consequences is that they might hold, in fact, they're pretty likely to hold undiversified portfolios. And so, let me go back here to the efficient frontier once again. If they have portfolios that are non-diversified, then there's no way they're on the efficient frontier. All right, so let's jump back into the middle then, straight and arrow, and let's go down to these people who are stressed out. The key word is anxious. I'll tell you just a quick story. I was at a meeting yesterday, and one of my colleagues, who's a supply chain dude, he kept showing me his phone. He gets these alerts that say, your stock, whatever the stock is, has reached an all-time low. So he showed it to me 3 times during the meeting, and I looked at him, and I'm like, dude, you need to throw your phone away. All right, so anxious. So if we're careful, this is the guardian, right? Focused on the future, protecting their wealth. That's probably a key to the guarding there, protecting wealth. On the other hand, if they're impetuous and anxious, then this is called a celebrity, likes to be the center of attention, has opinions, maybe recognizes their limitations, but seeks and takes advice about investing. All right, so you see how this goes. And I want you to be careful. One of the weaknesses, and we'll talk about this as we go through the slide deck, is that lots of times investors do not fall into one of those 5 categories, and that probably makes a lot of sense. Here's the advice that I'm going to give you. Are you ready for this? I'm going to tell you to think of these 5 individuals and pick somebody in your own life who would fit in that category, who has those kinds of personality traits. And so when you get to this question on the exam and you're reading the question stem and they talk about this individual and they have these characteristics, you'll say, oh, that was Aunt Betty or whoever it is. I promise you that will help you answer these questions here on the BB&K model. And then moving on to the last Pompian behavioral model, and I'm going to go ahead and pause here for just a second. Those of you, and this should be all of you, who go ahead and consult the readings, you'll notice that the lead author on this article is Michael Pompian, and so here is his model. And I'm guessing that the Institute is probably sensitive to the fact that he has written this particular reading, and so you can take that for whatever it's worth. This might have a higher probability of showing up on the exam. All right, what Pompian does initially is says something like, all right, let's follow some steps to try to identify and classify behavioral traits or behavioral investors. You know, remember, I tell my students this all the time, is that when you visit with clients, you're going to have clients that have some behavioral issues, but some might have this much and some might have this much. And these steps are probably a really good way to make that initial determination. So step 1, interview the client, right? So let's go ahead and ask the client, a series of general risk questions. And I'll give you a crazy example here. Like let's suppose that you asked your client that, hey, if your friends got together and said something like, hey, we're going on an airplane today, bring your parachute. We're going to jump out from 10,000 feet. Are you ready to go along? So if you answer yes to that question, then that probably is some indication of your general tolerance for risk. But if you're like most people, you're probably, and me included, you're going to say, you have to be out of your mind. Why would I want to do something like that? But anyway, that's still indicative of some kind of risk tolerance. And so this is what you do. You plot that risk tolerance on a graph. And of course, you'll have other types of questions that are in there, not just the crazy ones. They'll run the entire spectrum. And we talked about these at level 1 and level 2. And then the third part here, this is the important one. We're going to test for behavioral biases, and we're going to separate them into the spectrum of passive and active. And there's an entire spectrum in there. And what we're going to find out is that at each end of the extreme, that these individual investors are more likely to have emotional biases. Think of them as being super passive or super active. But if they're somewhere in the middle, they're probably going to be more susceptible to cognitive errors. And then we're going to categorize each investor into one of these behavioral investor types. And so let's go ahead and work through those bits. So the first one is a passive preserver. And so my advice is to get out your phone and take a picture. Here, I'll show you what we have coming up. We got this one, there's a 2, there's a 3, and there's a 4. So you might want to take some pictures of these slides so that you can have them in your slide deck on your phone, and you can look at these while you're riding on the train or while you're having dinner by yourself or wherever else you are. All right, a PP, a passive preserver. Now remember that in the question stem, and remember you're going to have a vignette that has an entire page worth of paragraphs in there, and so somewhere in there you're going to have some type of these characteristics. All right, very low risk tolerance, not financially sophisticated. Mostly acquire their wealth through high compensation at work or inheritance. All right, so that swings back, and that adds a little bit of a layer to what we talked about in that first model. Emphasizing preserving wealth. I think that's an important distinction here for the passive preserver. As wealth and age increases, you're probably becoming more and more. Now, I'm 61 years old. I still have children to get through college. I still have children to get jobs. I'm probably going to be teaching for another 5 to 25 years. So I'm not sure if I'm in this category just yet, but I probably ought to be. focus primarily on family and security. That sounds like me. Would rather avoid risks. I'm not sure that sounds a whole lot like me. But here, look at that bullet point over on the bottom right. Primarily suffer emotional biases, right? So that's what we're on the left-hand side of the spectrum. And the reading is kind enough to list some of those: endowments, loss aversion, status quo, and regret aversion. And let me just remind you that we spent some good time on that first reading at level 3 on identifying those particular types of emotional biases. So if you need a review, go back and watch the other recording. Now notice the last embedded bullet point may show some cognitive errors. So even though they're on the left-hand side of the spectrum, it doesn't mean that they can't have mistakes of the brain. And that's what we're going to learn when we focus on the LOS. The limitations of classifying is that some of these investors, they can be kind of a hodgepodge of all of these things. But the reading is kind enough to identify anchoring and mental accounting. All right, so here's what I think is the important part of this. Once we identify, then, and remember I said this in that first slide or two in this slide deck, that the question becomes, okay, how do we handle this problem? And sometimes the answer is, well, you just have to deal with it. But that's not what the reading, and that's not what the Institute wants us to do. They want us to, I'm not going to go back to that previous slide. What were we supposed to do? We were supposed to, improve the quality of the relationship between the client and us as the wealth advisors. Now, one of the interesting things about the reading is that when they get to the paragraph on how to advise each one of these, they use the word may. This particular investor may be difficult to advise, and so driven by emotional biases. But we learned that back in that first reading. And so this second arrow point is an important one. I do this to my students and my children all the time. I'm a big picture dude, so focus on the big picture, which is, hey, what are your financial goals? Do you want to send your children to college? You want to have a retirement balance of $5 million? Whatever that is, we're going to focus on that in the long term, right? The strategy, our strategic asset allocation model. So we probably don't want to put a model together and put a matrix together where we say, oh, here's your standard deviation, here's your Sharpe ratio, here's your beta, here's your R squared, here's all this stuff. Forget about this for the passive preserver. Look at the third one. Advice should lean more on the impact of the investment decisions on the investor's emotional aspects. This is like my colleague who was stressing out in a meeting because his stocks were falling during the trading day yesterday. This was also, of course, my father in his later years of life. He would get his monthly statement from his wealth advisor, and if the balance fell from the previous month, the first thing he would do is pick up the phone and yell at me because somehow it was my fault. Take time to trust their advisors. Yeah, that's probably important. All right, friendly follower. So we're moving along here. Here, let me just go back here to this. Now, we're not doing this model here, but we're still incorporating some of the things inside of this model. So we're building on this one, so we're moving along the way. So where am I here? All right, so friendly follower, low to medium risk tolerance level. So there we are along that spectrum. We'll take advice from friends, colleagues, and advisors. So that's important. So in the reading, they also say may be difficult to advise, but they also emphasize the reading that they may not be. All right, so they overestimate their risk tolerance. This is one that I like because they're so willing to think that others, maybe they're more highly skilled, maybe they have more experience, maybe they're just smarter. Fear of missing out and may end up taking unnecessary risks. That's fine. Financially literate, take up advice, but they probably don't enjoy the investment process. And so remember now we're getting in the middle here. So cognitive biases, availability, hindsight, framing, but they also might suffer from regret aversion. All right, so difficult to advise. There we go. Maybe difficult to advise, but they may not be. You know, that depends on the magnitude of those emotional biases. And so if you get the question that says, you know, here's a friendly follower, and they suffer from the following cognitive errors, you know, somewhere in the middle, you might say something like, you know what, they might be easy to advise if they don't have any emotional biases, right? That's the important part at the end of the spectrum. Yeah, look at that second arrow point. You got to be careful. They might say yes, but they might regret later. That's why that regret aversion pops up in that first box up at the top. Should be advised on the importance of diversification, education, and you know, I'm a big believer that regardless of the client class or type, that it's our job as wealth advisors to educate all the time. I mean, I'm an educator, I'm an academic, so I just try to educate all the time. All right, how about the independent individualist? All right, so this is an active investor, medium to high risk tolerance. So you guys see this now. We're moving along this risk tolerance spectrum. Independent mindset, strong-willed, trusting their gut feelings. Boy, they might even do some of their own research. My colleague, this is what he does. He comes into my office and says, hey, here's a stock. Here's the beta. What do you think about it, Jim? And I look at him and I'm like, dude, I'll tell you what I have invested in, but I'm not giving you advice on this particular stock. Here's a good one here. Independent individualists, they often resist following a financial plan. So what we're doing is that, you know, we're putting together this policy statement. And remember, the policy statement, it's not like it's a one-page document. You know, I mean, it can stretch into tens of pages, you know, if you include some appendices in there. And so this might be a client who is difficult to advise. Look at that top one over there on the right. They make an investment decision without seeking any advice. Yeah, they can be rigid, likely to be contrarian. Boy, I like that one as far as an example on the exam. Primarily suffer cognitive biases. So once again, we're in the middle here. Conservatism, availability, confirmation, representative biases, but they're probably going to be overconfident, and they might have a self-attribution bias. How do we advise this? They may be difficult to advise. They're independent thinkers. You know, this was an interesting concept as I was reading this, and I'm trying to make some sense of this. They might not be aware that they are contrarian. And I was trying to think of some good examples. I really couldn't come up with any other than the simple fact that some investors out there might just like to express their individuality by saying something like, you know, I'm right and everybody else is wrong. That sounds like contrarian to me. How about this last one, the active accumulator? So here we are at the far right scale, high risk tolerance. So they're aggressive, they're probably entrepreneurs, they're hands-on with their investment decisions. They probably are aware that we have put together a policy statement for them, but they may just ignore it totally. High portfolio turnover rates, fast in making decisions. Look at those emotional biases. Overconfidence, self-control. Remember, they're at the other end of the spectrum, so those combinations are can be insufferable. Look at that first arrow point. This is what the reading says. Yes, these clients will be the most difficult to advise. And so I mentioned that to you just so that you're aware that if the question stem identifies the active accumulator, then go ahead and just say, whatever the question is, just go ahead and write, yeah, this person is probably going to not want to listen to anything that I have to say. Lack of self-control, yeah, demonstrate. All right, so take a picture of those as you went through. But here's a good summary table of this spectrum, and look over on the far right column. This is what I was telling you. The passive preserver and the active accumulator, they will primarily suffer from emotional biases, and then the two in the middle, those are cognitive errors. So this is a super table there. If you can have this memorized for the exam, this will help you answer lots and lots of questions. All right, I told you it would take us, what was that, 10 or 12 slides. So let's go ahead and do limitations here. And I've already said a couple of these. They might show both emotional bias and cognitive errors at the same time, and they might show multiple emotional biases and multiple cognitive errors. And so this is difficult to try to classify an individual into one category. And so I'm guessing that if I were crafting these questions, I would have one question stem where it was clear that we can identify the client into one class. But then I would ask a follow-up question for another client who might exhibit, multiple kinds of things. And one of the good ways to do this is right there in the blue box. I'm sorry, the orange box. They're going to change their behavioral type as they age. And so look for a question stem that says something like, here's a client, and then there's a break in the paragraph and it says, 10 years later, here's the same client. So they can change over time. Individuals have unique circumstances. That's why it's so important to fully question and get to know the clients. And in fact, when you have the client go through these questions. And by the way, some of those questions for identifying the behavioral types here, let me go back here. I'm not sure if I said this, but this is important. Yeah, this blue box there, the third one, test for behavioral biases. You're probably going to ask the question, and here's a simple one that says something like, are you interested in wealth preservation or growth? That says a lot about a potential behavioral bias. Do you prefer a stock that pays lots of dividend? Do you prefer a bond that has a high coupon rate? Or do you want a zero coupon bond or a non-dividend paying stock? Those are really good questions. Or was I here? Or was I here? No, these are really good questions to get to these unique circumstances and psychological characteristics. And look at this last one here. So this is one of those, you guys ever watch the Larry David show? There's one episode where he does something about the comment of having said that. He goes through all this stuff. Now, having said that, something. And so this is what this last one is. So having said all of this stuff here, and we've spent lots of effort and resources in trying to identify clients. So look at this. Yeah, they're going to act irrationally, and predicting that irrational behavior is virtually impossible. So notice how beautiful the Institute is in preparing you guys for the exam, because you're going to be able to write some of these things down, in the essay questions. So, I think that's probably a great answer for a vignette question that says something like, how do you deal with this prediction? And you probably could write, I don't have any idea what to do, but I'm going to be right there. And I'm going to help this client when he or she acts irrationally. I'm going to be ready for it. All right, moving on to the next set of LOSs. How are we impacting the advisor-client relations? All right, so traits of successful relations. So the advisor understands the goals. So we've been talking about that, not just in this slide deck, but in level 1 and level 2. Consistency in the approach, meet the client's expectations, and then both parties will benefit from that relationship. And so this swings back to that risk tolerance questionnaire that I was hinting at in an earlier slide, is that not only do you read the answers that the client shows us, but what we do is we need to go ahead and follow up and say, hey, I noticed you said that you're not going to jump out of an airplane at 10,000 feet. Tell me why. And if the client looks at you and says something like, I'm not crazy, well, then you could just move on to the next question here. All right, how about challenges? All right, so emotional biases are probably not captured by the questionnaire. And that's why I always emphasize to my student, and the reading mentions this as well, is you got to have this follow-up and this ongoing relationship, this consistent relationship, convincing the client that, hey, I don't really feel like jumping out of an airplane. Find some common ground, and then you can share your experiences so that, we're better off able to put together a policy statement that is broad and deep. We also have to be worried about the framing of these questions. I think in one level, I gave you the example when we had the behavioral reading there was a really cool study done by a food store that put out packages of ground beef. And on one package it said ground beef, 20% fat. And on another package it said ground beef, 80% fat free. And so what they found is that everybody came and they bought the 80% fat free. They bought up all of those and they left all of the 20% fat, even though the meats were exactly the same. So the framing of how we ask the questions might give us some type of answers that are not indicative of what we're trying to search for. And then, of course, depending on the context, clients can give answers that are all over the map, because it's difficult. It's difficult to come up with good. Well, you know this from taking level 1. It's difficult to come up with good multiple choice questions. All right, the reading then goes ahead and it talks about me. It doesn't mention Jim specifically, but it says something like, you know what, we've done some studies on defined contribution plans. And what we have found is that there are some behavioral biases. And right there, it could have says, here's Jim. When was the last time he changed his asset allocation in his retirement portfolio? And the answer is, I don't even remember when I have done this. So this is the status quo bias, right? We're not going to make any changes, and this is probably going to result in a less than optimal portfolio. Now, what I do is I'm not completely status quo biased. I don't want you to think I'm a total sufferer of this bias. But what I do is that I do change things depending on my age. And so there are target funds. But look down at the very bottom, and the reading emphasizes this. The target date fund is not a full financial plan. And so what we do is that I kind of do this every so often. But I didn't make any massive changes after the 2008 financial crisis. I didn't do any massive changes after COVID. I just do changes after, I'm not even going to say when I do changes, but not optimally probably. So this is a big one, this status quo bias. So that's status quo bias. That sounds like a really good exam question. Naive diversification. I know my colleagues at school are guilty of this. They'll just say something like, oh, you know what? I think I'll have 6 different funds and I'll pick these 6 funds and I'll start out with the exact same allocation in each of those funds. Now, this happens in colleges and universities, but what the reading does emphasize is that concentrations of employer stock, and this is the direct result of familiarity and overconfidence and illusion of control. Remember, we talked about all those in the previous reading. All right, so here's a couple other ones. Naive extrapolation. This is my example that I give students all the time, is go back to 1998. I think that's the right year for Enron. If you're an Enron employee, your income comes from Enron, your investment portfolio comes from Enron, and your retirement portfolio comes from Enron. That sounds an awful lot like naivete. Framing, we talked about that, loyalty, financial incentives because of maybe some tax treatment, or lots of employers say something like, hey, if you want to buy our stock, it's trading at 100, we'll let you buy it at 95 or 90 or maybe even 10. Who knows? Excessive trading. I go back to, are you guys old enough to know that when we first came up with this thing called the internet, day trading became super popular back in 1998 or whatever year that was. And so there were tons and tons of people out there doing unnecessary trading and excessive trading. And I even had students who would come to me and say, oh yeah, I made $11,000 yesterday in the stock market. And I'm like, well, you know what you ought to do? You ought to cash in and put it in a retirement account. I'm not sure too many of them listened to me. And I never really heard the follow-up, which was, oh, I lost $13,000 today. All right, why do we excessively trade? Right, because they're available. Why did the dude rob the bank? What did he say? I robbed the banks because that's where the money is. Overconfidence, self-selection. We pay all these unnecessary commissions and taxes and trading costs. And so clearly we're going to underperform. We did talk about regret aversion in that last reading, and I'll go ahead and include the disposition effect here. We hold on to losing positions too long, sell the winning positions too soon because we don't want to have the loser stamp placed on our forehead. And if we can have the winner stamp placed on, we want to do this. Home bias or familiarity bias. So we're gonna have fixed income securities and equity securities that are probably in our home country, or those that we're familiar with, or the results of availability, that kind of stuff. All right, how about process of portfolio construction? So look in the bottom left box. What do we know from Harry Markowitz? We're going to start with that minimum variance portfolio, and then we're going to work our way up in a non-linear fashion. We want to maximize expected return while minimizing variance. What did I say in one of those earlier slides? These are kind of mutually exclusive goals. So the question then becomes, how do we fit all of these behavioral issues into an optimal, efficient portfolio? We've got each of these slices over here. What we're going to do is we're going to use our knowledge of behavioral finance, and we're going to say, let's go ahead and say, let's have a target date funds to overcome some of these biases, maybe not all of these biases, but clearly the reading focuses on the status quo bias. And there's probably some other biases that the target date funds can overcome. The reason that the reading emphasizes this is because you and I can understand it here, and it's easily understood by clients. And what happens then is that we're going to ask our clients to rank their objectives. What's most important? What did I say earlier? The $5 million retirement balance or sending the children to college? Let's go ahead and rank them. And so what we find then is that portfolio construction in a behavioral universe is probably a layered portfolios that might have different risk and return objectives. So here we go. This is what I was saying, structured in layers. Each layer is related to an investor's kind of, let's figure out what we want to do in life. They're based on mental accounting bias. And they probably do not achieve optimal portfolios, but each of those layers makes the client more comfortable with the policy statement and the investment process. And so our job then is to move up into that northwest corner and try to push our clients into that optimal region and perhaps even beyond. But what we're trying to do over time, and remember, there was one word in one of these slides earlier that said process. I think the reading is even called processes. And so, let's think about what that means. We have a client who has all of these, a wheelbarrow full of behavioral issues. And so over time, we reach in and we get rid of one and we get rid of two. So by, 10 years, 15 years, we've got this client at a point where we can say, you know what, this is probably a Harry Markowitz efficient frontier. Now let's switch over from our role as the wealth advisor or the to our role as a financial analyst who's doing all this research out there. So we can be overconfident, right? So we have tons of data at our hands. When we don't know something, we can pick up the phone and call somebody, or if we want it confirmed, we have sophisticated forecasting tools. We have tons and tons of experience. So what do we have? The illusion of knowledge and availability bias. Those are probably two sublayers of overconfidence that are going to affect our performance as an analyst. We probably also have illusion of control. We probably have hindsight bias, and then maybe some self-attribution. And so here's the great question, I think, so we can identify those. Here, let me go back here real quickly. So overconfidence, that simply means that we're going to probably have some of these kinds of biases just because we think we're smarter than we are, or we think we're more skilled than other analysts out there, and that our forecasts are going to be more on target, and we're probably going to be more likely to make an excuse if we miss our target. We're going to be able to say something like, oh, you know what? How was I supposed to know that? So overconfidence also means that we're probably not going to learn from our mistakes. But how do we avoid this? So I like this this bottom part here. We're going to use the Bayes probability formula. Oh my gosh, we've talked about this. And did we do this in level 1? Yeah, we did in level 2. So we have this data set and we say something like, okay, I expect this firm to increase its dividend by 10%. And then we have some follow-up information, and maybe it's something on inflation, maybe it's something other macroeconomic news, maybe it's something specific to the firm. Maybe the firm hires a CFO, and in an interview a year ago, he said, "Oh, I hate paying dividends. I'm never paying another dividend as long as I live. If I have anything to do with it, if I can influence the board of directors." So we need to update that probability. Remember the Bayes updating probability. So think about that key word in a question stem. Yeah, benchmarking. We learn about this in all different levels. Make sure that we compare and contrast and look what other analysts are doing. It has to be the same data set. Well-structured and accurate feedback. Of course, when we make a prediction, when we make a forecast, we're going to probably do it with some level of error. And so we need to ask our colleagues, hey, what do you think about that? Why did I make that mistake? Come up with a structure that rewards accuracy. All right, that makes sense. We can be influenced by management. This is the framing issue that we were talking about before. And I tell my students this all the time. Let's suppose that I'm Jim and I'm a dissident shareholder and I want to run as a competitor for the next board of director elections. And so what the firm does is that they put out a proxy statement and they have a picture of my competitor. And this picture, it's nice and beautiful. It's framed perfectly. This person, they're just well groomed and they just look great. They look trustworthy. And the management then lists, here's this person. He's been on the board for 1,000 years. He donates all his money. He does all this great philanthropy stuff. We recommend you vote for this particular person. And then, by the way, here's Jim. And there's a grainy picture of me, and it says, Jim stinks. Don't vote for this guy. So framing is super important. That the managers are going to give us the best case scenario. Anchoring and adjustment bias. This is so important. And the example that I always give students is the following, is that, the Dow Jones Industrial Average at one point it hit 10,000, and then at one point it hit 20,000, and then at one point it hit 30,000. And someday it'll probably hit 40,000. We don't really know what that day is. And so if you flip on the news, we're always anchored under 30,000. After the inflation recession, we were below 30,000. The announcers always say, when are we going to get back to 30,000? And I guess that's interesting, but I don't really know that that's important. So make sure you're concerned about anchoring. Availability, of course, if something is right near us, we're going to go ahead and look at it. If we have to search for it over there, maybe we won't find it. I have a great example in my work at school. There was a report that I knew was given to me months ago, and it was in the back of my mind to find it, but I never really looked for it. I knew there was important stuff in there, and I finally came across it, and it was super important. And I wish I had that a month ago, but I didn't. How about remedial actions here? Discipline and systematic approach. This is why the Institute spends so much time in level 3 about the contents of the policy statement, right? The Institute wants you to interview the client. They want you to go ahead and craft the constraints. They want you to compute a risk and return objective. They want you to do all this, and they want you to do it like this and like this and like this. Now, of course, there's variability in what a good policy statement looks like, but every good policy statement is disciplined. It's consistent. It's transparent, and it's the result of some system that was developed over lots and lots of years by the Institute. Right? Comparable data. We did that already. How about biases in research? Confirmation bias, this is an obvious one, right? If I think that a company is really, really good, then I'm going to go ahead and search the Wall Street Journal for articles about this company written by somebody else who really thinks this company is really, really good. Gambler's fallacy, reversal to the long-term mean more often than it actually happens. This is what we know, right? We know there's a reversion to the mean. And the example that I gave you guys back in level 1, how many of you watched this recording? I always give the example of a golfer, professional golfer like Tiger Woods. Suppose Tiger Woods on Thursday and Friday. Now this is when he was really good, mind you. When on Thursday and Friday, if he shoots, rounds of, let's say, 62 and 64, do you expect him to do that over the weekend? And lots of people say, oh my gosh, Tiger, he's doing great. There's no way he's not going to break the course record again and the tournament record. But inevitably, Tiger will shoot 71 and 70 and he'll probably still win over the weekend because his mean score was, let's say 68, whatever it is, in that number. But we need to be super careful about the timing. You can do this over the short term with a golfer, but you can't really do this in financial markets. So timing here is everything with that gambler's fallacy. All right, what are some remedial actions for the bias shown by financial analysts? Pay more attention to objective data. Oh, trailing earnings. Boy, we did all this back in level 2, right? All of those different indicators, those were in our economics readings. Evaluate previous forecasts. Yes, so I love doing this. I love saying, okay, this is what we did over the last 5 years. Let's compute some kind of a variance or a standard deviation, and let's make sure that today that we're not anchored back in there to, what did I just say, a Dow of 30,000. Assign probabilities. I love this, not only going back to Bayes, but just going back to just regular old statistics and figuring out, in the simple sense, let's say something like, we think that the economy has an 80% chance of expanding and a 20% chance of contracting. There we go. Assign probabilities to, general outcomes so that we can have, some kind of a base rate, structured process, and document. The Institute with the policy statement is very interested in documenting and keeping notes so that when there is an issue, and there will be an issue. If there is an issue, you can just go back to the client and say, oh, well, here are my notes. This is why I made that decision. And here's the day when we had a visit and you said you were okay with this. Now, if there never is an issue, you still have those notes and you still are able to document it so that you can show the client that you have been performing your decisions in a systematic way over time, right? This improves the relationship between the wealth advisor and the client. All right, how about committees? And so this is what I said earlier. Let's go ahead and think about what this has to do with, maybe the board of directors and maybe all of the committees on the board. So there's, this can be board of trustees, that can be research teams, analyst collaborations, or investment clubs. We have a student managed fund at my school. I'm not the advisor, my colleague is, but I sit in on there all the time. And my students, they love doing all this work. Our school has given them, a couple $100,000, and so they're managing real money. And I listen to the way they talk, and I remind them all the time that they need to be careful about exhibiting some of these biases. So poor decisions by like-minded individuals. So my students, they all had my class and they all have my colleague's class. And so my colleague also holds the designation. And so, we of course teach in this similar manner. And I warn them. I say, what if my colleague and what if we're wrong about all this stuff? You guys are blindly following us. And they say, no, Jim, we're not blindly following you. We're doing all the work. We're confirming that what you have taught us is accurate. And so this is really good stuff. Look at the bottom there, groupthink and social proof of bias. I mean, I've said this to you before. I don't have Facebook. I don't have I don't have Instagram. I don't do any of that kind of stuff. So I don't really know what that means, but I'm sure it's out there. And I'm guessing that you guys know that if you're in an investment club and all of you get, like my colleague at school yesterday said, oh my gosh, your stock is following, you drop what you're doing and you run to FaceTime each other and say, the earth is falling. What are we going to do? All right, how are we going to mitigate the effects of groupthink? And so I like to start on the right-hand side and work my way back there. Foster mutual respect among all members. So look, I see this with my students. These students, they try to outwork each other. And so they have a tremendous amount of respect for each other. So fostering mutual respect means, hey, let's bring the same level of effort and resources as contributing factors to the group. Then we'll be able to respect each other, right? Of course, you have to have strong leadership. And then at the end of a meeting, everyone should say something like, you know what, I don't like this. I disagree with this, or I'm not quite sure about this. So encourage dissension, and then promote diversity, not just in backgrounds, but diversity in training, diversity in experience, diversity, all kinds of diversity, because what that's going to do is that's going to ultimately lead to success in those other 4 blocks. Now, I want to give you a little bit of a history lesson here as we move to the end of this reading. Back in the early 1980s, the University of Chicago came out with these things called the CRISP tapes, which made available to researchers throughout the world daily stock prices. And so researchers could now use daily stock returns in trying to test the efficient markets hypothesis and anything else that they wanted to test. And so the results in general supported efficient markets hypothesis. However, there were pockets of inefficiency, like momentum. And so this is the direct result of stuff that happened in the academic world. And so what we found is, let's go ahead and try to identify those pockets of inefficiency, and let's try to figure out a reason. And what we have found is that those pockets of inefficiency are most likely the results of these behavioral issues that we have been talking about. So here's one, momentum, right? So if the stock price is going up, then everyone is going to jump on it, from analysts, right? We just did that. From individual investors, right? Everybody's interested in this stock. They don't want to be left behind. And so it establishes momentum, right? So correlation of price movements and recent past prices. Excuse me. Markets often operate based on fear and greed, and there's the herding effect, right? We all want to be with the herd. Go back to those, you guys watch the Jurassic Park movies. Oh, those are some of my favorite movies. When the dinosaurs are going this way, all of the dinosaurs are going that way, and it's probably because there's a T-Rex following them. All right, how can we explain this momentum effect? It probably has a lot to do with availability, has a lot to do with hindsight. Bubbles and crashes, of course. An irrational market forces taking control. When I think of an irrational market, I think of anarchy, really, and that's I'm not sure if that's a really good thought to put into my brain, just of total irrationality on the floor of the New York Stock Exchange. But the irrationality behavior probably results from a misinterpretation of data. And I'm just going to go ahead and say the example that I think of all the time is whenever the Fed chairman speaks. Do you remember, are you guys old enough to remember the term irrational exuberance? If you don't know what that is, go ahead and look it up. And then you'll find out about irrationality, a response to markets. So look at this, not justified by logic or company fundamentals. And then, of course, the Institute couldn't get away without bringing in some type of a standard deviation measure. So asset prices fluctuating more than 2 standard deviations away from the mean. Remember, we learned that with central limit theorem. What was that dude's name? Chebyshev, where, what did we say? About 95% of all observations fall within 2 standard deviations of the means. All right, bubbles and crashes, what do we have? We have lots of overconfidence, we have hindsight, we have regret, we have self-attribution, and we have the disposition effect. Now, I love this slide here because investors analysts, lots of people on the floor of the New York Stock Exchange, they like to divide the stocks into two families, right? Value family and the growth family. So what are value stocks? We know this from our previous discussions. Low PEs, high book to market, high dividends, and growth stocks are just the opposite. All right, so what does this mean? Value stocks tend to outperform growth stocks in the long term. So what would a rational investor say? The rational investor would say something like, well, I don't really have a good reason for that, right? Value stocks are probably have less risk, then how could they have greater return over time? So how do we figure this out? Well, here's again these pockets of inefficiency. The halo effect, extrapolating positive attributes of a company onto other facets of the same company, such as stock price. So the halo effect there. And how about the home bias effect too? Over focus on local markets. This probably has something to do with familiarity as well. Wow, that was a fun slide deck for me to get through, because remember now, as a good PhD student, I learned tons and tons of stuff about efficient markets hypothesis. But it was only after I got my PhD, this is the early 90s, when all of this behavioral finance stuff started becoming entrenched into the finance literature. So it's only in the last, 30 years or so that I have become fascinated with behavioral finance, and I think it's really cool things. And I'm certain that the Institute has a similar kind of an attitude. So look for really good questions here. If you look at the end of this reading, there are 3 vignettes that cover the entire spectrum of this reading. So I encourage you to go and practice writing these answers out. So have a great day. Thanks for watching, and good luck studying.